Officer, and in February of this year was named CEO. So Terry, I'll have you start off with ARC's key messages to the market and maybe talk about how you navigated the CEO transition during the lockdown. I'll follow up with some more detailed questions, and if anyone joining us today wishes to submit a question, just use the form on the left of your screen. And with that, I'll let Terry take it away.
Okay, thanks a lot, Josie. So I guess I'll start, with the key message here. I'd say despite this whole COVID crisis, we've done a great job of managing our business prudently. We obviously acted quickly, cutting the capital and the dividend early to protect the balance sheet. We had strong hedges coming into this year, but we layered on some hedges quickly on the oil side, so we're 70% hedged on the oil for 2020. We have ample liquidity of $1 billion, so no concerns from that perspective. Operational execution has been exceptional. We've had no COVID concerns, so safety has been very strong. We've completed construction of Dawson 4 facility and brought that on stream in Q2, so we're ahead of schedule, under budget, and great safety. We shut in production when it made sense, and we brought most of that production back on now with the higher oil prices. Our operating cost control has been great, and we expect to be in that low range of our guidance. And we continue to advance our ESG leadership, which will be detailed in our 2020 ESG report that will come out in September. So based on all of that, we have a line of sight to delivering strong free cash flow by the end of the year based on the forward curve. And this means we'll have optionality on what to do with that free cash flow. But our first priority is definitely lowering our debt back down to our debt to cash flow range of below that 1.5 times, and we have line of sight to doing that by year end. And then we can decide on any half cycle capital investments that we want to make to fill up that spare capacity that we've built with Dawson 4. So we're in a strong financial position today to leverage to be able to leverage that advantage position, and if the right opportunity presents itself. So that's a quick snapshot. When you talk about the transition of my role here in navigating this crisis, I think the big thing for us is we've been really focused on what we can control and be clear on our top priorities, and that top priority was safety. Right from day one, it was focused on safety for all of our staff internally and our contractors working for ARC. And like I mentioned, we've done a great job in ensuring safety in our operations with no issues at all. Protecting that balance sheet was another thing that we control, so managing the capital and dividend early in the hedges. Over-communicating in time of crisis is another thing that I really focused on, especially for our employees. We needed to make sure everybody was focused on doing their job. And I always joke with Mr. Bibby that not everybody can worry about the oil price. That's his job. Everybody needs to worry about their parts of the business. So communication is a big thing in this crisis through this transition also. And then focusing on our operational excellence, which we always have done in the past, and we continue to do, and especially in a time of crisis, you need to be focused on that. And then ensuring that profitability also, I think, shut in production because it didn't make sense to produce it from a profitability. We deferred capital activity when it made sense to stop, and we started some of that back up. And I'd say when I look back through the last 5 months, some of the learnings that I take away from this is you need to act quickly and decisively in a time of crisis. And it's hard to do because there's a lot of ambiguity, so there's uncertainty there, but you still need to make decisions. And that's what we did, and we made decisions to protect our business early. So I think that was a good learning for us about making sure that we act decisively. The second being owning and operating our facilities. It is so critical, and it's even more critical in times of low commodity price, and this just helps ensure survival. It looked pretty bleak when oil was $- there for a day, and low for quite a while there. But when you can control your destiny from an operating cost perspective, that is critical. And then that need to over-communicate, I think, was another learning that you need to make sure people are calm and controlled and then focused on what they are doing. Everybody needs to be focused on their part of the business to make the business go around. And coming back to ensuring that strong balance sheet is also reaffirmed learning that you need to always be in that advantage position to allow you to be opportunistic for us. And that's kind of where we sit today as a business, is that we have optionality and we can be looking at opportunities, and not many companies can say that in today's environment. So that's kind of just a quick snapshot of the business, but also the transitioning and the learnings through this first 5 months anyways.
Yeah, so you had mentioned that ARC made the decision to cut CapEx pretty drastically and pretty early on by 40% to around $300 million. So how are you operating or evaluating opportunities in the second half of the year?
Yeah, so the majority of our capital was spent in Q1, and we finished off the facilities at Dawson 4, and now any half-cycle capital in H2 will definitely be directed more towards Sunrise and Dawson, and that's kind of will be our focus more on the gas-weighted assets. So that's kind of where we're looking at our capital for go forward here for the remainder of the year.
And so how has ARC's fundamental outlook on oil and gas prices changed over the last 6 months, and how will that guide your capital allocation decisions in the near medium term? And maybe include how you're thinking about the dividend, which you cut back in March by 60%, and obviously you emphasized balance sheet strength as well. How do you balance that with the next phases of growth?
Yeah, so looking at the price fundamentals, like from a gas perspective, very near-term objective, like I mentioned, we'll be focusing on that gas production. So we see that we can make good money at where gas prices are above that $1.80 AECO. So half-cycle capital will be directed to the Sunrise and Dawson. And we anticipate the AECO to be strong relative to the U.S. markets. The U.S. markets and have recovered, and are recovering in this fall and winter should be fairly strong too. But if you look at AECO, right now, like I think there's 15 drilling rigs going on in Canada, in Western Canada right now. Like that is extremely low, probably 10 times, it should be 10 times that for a normal this time of year. And so production on the gas side is going to fall, and it has to fall, and that's going to be constructive to the pricing. Longer term on natural gas for AECO, like natural gas demand growth, we expect to be strong with constructive. That'll be constructive for pricing, and that's based on like LNG Canada obviously happening, the system expansions of NGTL, also the coal to gas conversions, and there's strong intra-provincial demand going on. So we see that natural gas in the very near future, and then for the next few years to be quite constructive. On the condensate side, immediate near term will be tied to obviously the economic recovery, but we do, and we think there's some volatility going forward here, but we do see that a path back to that $45 WTI over the next 24 months. We think there'll be stable demand profile over the next decade, obviously with the oil sands there, and probably the cost of transportation is likely the floor for differentials in that $4 to $6 range a barrel. And then also you got to remember that our condensate is basically light oil, so we blend it right now. Our condensate sometimes is light oil, so there's value in from a refining perspective. We can sell it as light oil if the condensate differentials actually blew out. On the dividend, yeah, we cut that dividend early on, and that actually was about right-sizing that dividend. It was a little large for the production base that we had and the cash flow and profitability that we were realizing as a company. Going forward with the free cash flow, We have options of, obviously, the first option is paying down our debt. We want to get that debt back down to that 1 to 1.5 time range, probably to the lower end. And it'd be nice to harvest that free cash flow to actually build up some room on our debt to advance Attachie. That's another big project that obviously we're working on and planning for here in the future. So I see that in the near term, it's more about trying to harvest some free cash flow and looking to advancing Attachie down the road here. But further down the road, once Attachie's up and running and we have more free cash flow, I think the thing that Chris and I have been talking about was trying to balance our investments into the ground with a dividend increase and also share buybacks. Maybe we have some formula that we balance where that capital goes to those three in the future here. But that's something that right now we're more focused on the debt and then getting in a position to advance Attachie go forward here.
And is it fair to say that Attachie is still the next major project for growth for ARC?
Yeah, so right now we have productive capacity up to 170,000 BOE a day with Dawson 4 being built. Right now we're not at that, so any half-cycle investments are the first step to get up to that 170,000. But after that, yes, Attachie is definitely the next big step for us. It's such a massive resource, and it's more liquids weighting than Dawson and Sunrise and the majority of our other Montney assets. And that's something that I think right now we're 75% gas. I think we could have a little more balance. We're very constructive on gas, but with Attachie comes a lot of solution gas with it also. But I think Attachie is definitely the big next opportunity, and there's such a massive resource that there's multiple development projects there going forward.
For sure, and you talk about harvesting and redeploying free cash flow towards Attachie development, but it requires a bigger chunk of capital. So how do you think ARC will continue to move that forward?
Well, and it's interesting, like we do need WTI prices probably closer to $45 to advance that first phase. And with the significant free cash flow that we are looking at this year and the next year, it actually is in line of sight to be able to do that internally. We'll get our debt to cash flow back down to that 1 times, and then that's a time where we probably could sanction Attachie, and maybe that's at the end of 2021 probably time frame of sanctioning Attachie. But we're also looking at other options. Maybe there's some integrated midstream option that we can look at. We're open to different kind of ways of advancing Attachie, but preferably we'd like to advance it within our own means. And there's obviously we'd like to bring that value forward on that asset, but the commodity prices need to be constructive to advance that, and we need to see more stability in that. So in a couple of years time frame, I think it actually still with all the pieces would come together that we could actually advance Attachie within our own means.
Fair enough. So Terry, you oversaw ARC's transition from a disparate suite of assets throughout the Western Canadian Sedimentary Basin to a really focused Montney producer. So how do you envision this resource base going forward? Are you satisfied with the resource base that you have now, or are there any gaps in your portfolio?
Well, and you're right. It's we have transitioned to the Montney because Montney is one of the best plays in North America, and I would say ARC has some of the best quality acreage within the Montney also. We have well over 4,500 locations of future drilling opportunities identified. So we have decades of worth of development opportunities going forward here. So to put this into perspective, to sustain 170,000 BOE a day, we need 70 wells, drill 70 wells a year to do that. So it's a very efficient asset base. Am I satisfied with the resource base? I'm very satisfied with it because of the optionality that it provides. So we can be focused on dry gas, we can be focused on condensate-rich liquids and gas, or we can be focused on the lighter oil side of it. Right now our production mix is 75% natural gas. Ideally, I'd like to maybe see a little more balance with the crude oil and liquid side. And that's all about just managing the fluctuations in commodity prices that happen. So yeah, I would say that we're very, very satisfied with the resource base we have, and it's such a massive resource that we have many years to develop.
And then you also have, you talked about being a little more balanced, you also have your legacy Pembina Cardium assets that is oil weighted. It was a good source of cash flow when oil prices were good. So how does the Cardium fit in the long range strategy for ARC?
Yeah, so the Cardium is our only non-Montney asset out there. Cardium's interesting. It's a huge resource, 3 billion barrels of oil in place, 18% recovery factor to date. And so there's a lot of oil left in the ground. If time and technology can extract more of that, I believe that will happen. The Pembina Cardium, though, currently for us is less than 10% of our guided volumes. And the nice thing about it is it's a very low decline rate. As we grow our Montney liquids, though, it becomes even a smaller portion of our portfolio. And so there's always a time for an asset when it probably is more value in other companies' hands. And when I look at it, it's hard for the Pembina Cardium to compete with our Montney opportunities. And so it might make sense in someone else's hands because there are lots of opportunities still to drill wells there, but it's just challenged for us for it to compete on that capital. So down the road, as we grow our Montney liquids, I see that the Pembina Cardium will eventually be moved out of our asset base, but that's in a few years' time, I would say, before we do that, until we start building more of the lower Montney and Attachie going forward here.
Fair enough. And you mentioned that the Pembina Cardium might be better in someone else's hands. So what's your view on M&A within the basin right now? And even before the pandemic, there seemed to be a stalemate between buyers and sellers. Do you think this pandemic and the credit crunch will change this?
Well, I think there needs to be consolidation at a higher level. There's a lot of companies that have stressed balance sheets, meaning that their enterprise values are largely made up of debt. And that burden may actually be more than the intrinsic value of those assets. So some of them are challenged for us to look at and see any value there. From our perspective, we're looking at opportunities because we're in a position that we can, but any M&A activity for us, it needs to meet a certain 5 criteria that we have to pursue something. First being the asset has to be as good or better than what we currently have. We have great assets, so that's a tall order right there. We need similar ESG characteristics, or see the ability to get the assets to a similar state, because ESG is very important for our company and our future direction here. Also, an asset needs to be generating some surplus cash flow for us to look at that opportunity. And we need to look for opportunities that create some scale. Like, we're always doing little tuck-ins and stuff like that, but for something that's more meaningful, we need some scale with some some similar synergies or unique synergies for us, and it's probably more Montney focused because that's our expertise, and we believe the Montney is a premier play. And then also, whatever we're looking at, we prefer to have its own infrastructure so we can operate it and control that. So once you add in those 5 criteria, it makes the list pretty small. And so that's our challenge. We don't need to do anything. So we can, I guess, be picky on what we're looking at. And it's not just for the sake of growing and becoming bigger. It needs to add value and be profitable for ARC. So that's why we're kind of sticking to these principles of criteria on asset or on M&A.
Fair enough. So at this time, we're just gonna wrap up this session. Terry, thank you so much for joining us today and sharing your insights. Up next at 1:50 Eastern, TD's Aaron Bokoski will be hosting